Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, March 7th, 2017. I wanted to take a look at the broad markets, so just do a quick overview on the broad markets, touch on gold. There's always seems to be a lot of interest in gold and the gold mining stocks. I'll give you my thoughts there, and touch on a couple sectors that stand out to me now, and we'll wrap this one up very relatively quickly. This is actually my second attempt. I started this video just before the open today, got most of the way through it, and had a video card failure. I might have made mention on the site of a video card issue I had recently. Took a software update, figured it was over, but I've been here, done that before. Changed out video cards. My old ones were AMD, had problems with those. I'm working off NVIDIA video cards now for the last year or so, and I already have one failing. So short NVIDIA, and we'll check on AMD later. That one might be ripe for a fall as well. Those are the two of the bigger video card makers out there. All right, enough on that. Digress. Sorry about that, guys. Let me try to get through this quick since I'm behind now. This is a SPY daily chart, same one that was shown on the front page yesterday. I did an update with daily charts of the SPY QQQ IWM as well as the 60-minute time frames, and we'll hit on those real quick. Now, I had made mention in that post yesterday about this yellow trend line and how normally when a trend line is sliced through, more than one occasion, that I usually disregard it as being invalid at that point. And you can see here we broke down below it, snapped back above it, went back below it, back above it. But I did point out what stands out to me is the sheer number of reactions, and that's why I still think there's some validity or credence, if you will, to this trend line. If you look going back here in early January or February of 2016, we have the first reaction, second reaction, couple reactions here, and then we have broke down, back tested, and a very impulsive sell-off. And that was leading up to the elections. And then you have the big gap. That's the Trump pump afterwards. But what's interesting is, okay, so we did break down, had impulsive selling, back test, everything you want to see in a trend line to, a lot of more reactions, the more valid it is. Then if we zoom in, you can see here, with first time, we hit it for a few days, and then rolled back down off it. Support, a trend line is support when prices are above. Once broken, an uptrend line then becomes resistance when tested from below. So we had several reactions, about a week's worth. Finally moved up with an impulsive green candlestick. You want to see that when you break support or break resistance. So that helps to validate the trend line that it was an important level. And then you can see we came back in, bounced around it for about a week, and then finally broke down with an impulsive red candlestick. Another back test, finally got above it. And if you note here, we've now danced above that trend line for about the last 2 weeks. So again, something that I'm watching because of all the reactions. I give it significance. We'll watch that. If it breaks, the bigger line right now, or just as important, I would say, is this white uptrend line, which forms when you zoom out, a bearish rising wedge, confirmed or complete with negative divergences. You can see the divergent high. You can see the PPO has now made a bearish crossover. Those, especially a high with clear separation like that, that's a pretty good sell signal. You had one back here. You can see the crossover, and then we moved down quite a bit. You can see how we had an attempt, but that we never had a crossover right there. So when I say clean crossovers, I don't pay it too much attention when the lines are flattening out like this. I like this clean separation like we had here. You get a crossover, market just traded sideways and then fell. So there's a clean separation over there. Market went a little higher and then corrected. So that's something to watch for. And of course, this 80 plus overbought reading, we went above 80 on the RSI. I've covered this in static charts. Going back almost 20 years, I believe that's the highest overbought reading that we've had, either on the SPY or QQQ or both on the daily RSI. So extremely overbought, which sets the ground for a pretty significant correction. At least that's been the history, again, going back at least 2 decades here when we've seen, the RSI hit the 80 or more level. All right, so that's the daily time frame. We'll quickly look at the 60-minute, what I'm watching for here. Again, this was just a follow-up of the chart that I had posted yesterday. Late in the day in the trading room, somebody asked me if the SPY had taken out its trend line. So no, we're dancing on that daily trend line as I speak. Here's a potential uptrend line. Potential because we have a couple reactions back here, another reaction there. So let's see if this one comes into play. Now, yesterday the first level I posted is this 237.29, and now give or take a few pennies here, guys. That could be 10 cents in either direction. And it really was this reaction right here. So we've been dancing on that level since yesterday. We tagged it yesterday. I'm sorry. Let's see, where's the open? That was yesterday, Monday. Yeah, we did tag it yesterday, closed right here, and hit it again. So this is certainly coming into play as support. It's TA 101. Support is support unless broken. And if that breaks, that's so really at this point, since we've had a few pierces below it, you want to really move that line down. That's what I would do at this point. Just waiting to see a break of this low so far today, which is, if I grab that candle, that low is 236.92. That will most likely open the door for selling. We've tapped that level enough that if it's going to hold, the markets should rally now. Anything's possible. You can see here that line was a resistance, and it took a while. Tap, 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 a little failed breakout attempt, and then boom, gapped above it. So watch that level, potential trend line, and again, these are additional support levels. And, I think my minimum target at this point in time, and I say minimum, would be down here to the 232 level and this yellow uptrend line. That's the SPY. QQQ, we're on the 60-minute, we'll just stay there. Here's that uptrend line I'm watching, quite a few reactions. Looks like we've broken down and back tested, and we've been back testing below there. There's also this horizontal support level here, support/resistance around 130.72, give or take. These are 60-minute candles, so we're above that level now, but we are back testing the trend line, and it's not the only thing really significant on a 60-minute chart is where that candle closes. So far, we opened lower today and we ramped up. We're back testing now. Let's see what they do. For the Qs to be bullish, it'll need to take out this 136.10 level. We'll call it right about there if I can get it. Yeah, about, 131. 131.10 we'll call it. That would be bullish. And of course, the old highs. That will really do a little bit of damage here to the charts, but the bigger picture, again, we have these long-standing negative divergences, and I maintain these targets down here, and this purple uptrend line may come into play. Again, I can't give you a level because an uptrend line changes every day. So that's the 60-minute chart on the Qs, and this is the bigger picture. The yellow lines form the big rising wedge, a series of divergent highs and corrections that I've gone over many times before. And you can see if we tighten up that trend line, you can see how well defined that trend line captures all these reactions here. We've broken down and we're back testing it from below, following a divergent high, following a bearish crossover right here on the PPO, following these extreme overbought readings. And again, I see based on this that any correction will be sizable. In other words, I'm talking more than your usual run-of-the-mill 2-3% pullback. I think it'll be more than that. So let's see what happens as we get down here to this uptrend line, which is the bottom of the wedge, and we'll go from there. All right, IWM, as I mentioned, of the three major indexes that I'm covering today, SPY, QQQ, IWM. I have no interest to trade or the SPY long or short. Obviously, I've made clear that I'm short the small caps in the NASDAQ 100, and I do that. The higher beta indexes have more to fall. The SPY, you have a lot of defensive stocks in there, utilities and healthcare and other defensive sector stocks that will tend to hold up, dividend-paying companies that tend to hold up a lot better in a falling market. So that's why if this call for correction pans out, you'll probably have more meat on the bone on an IWM or QQQ short. And this is the daily chart we're looking at. There's an uptrend line. I had this. This is a trend line that really was capping these highs here. So we broke above that. And we're back testing that. So this is a potential support level here. I should have color-coded this a little bit different to separate it from this rising wedge, but the bigger picture, if you zoom in, the rising wedge has broken down. Very clear and steep negative divergence on the rising wedge. And again, just let's color-code. Well, I'll leave it white. No time to change it. There's the two lines, the rising wedge. Very steep negative divergence. Bearish crossover confirming those divergences. And when we zoom down to the 60-minute chart, You can see what happened here. I've talked about this. This was a failed breakout. We had a sideways trading range from early December, this whole range here. We broke out, came in, tested the top of the range, give or take, and did so with a divergent high. And so far, those divergences are playing out. Prices have fallen clearly back inside the trading range. So in my book, that's a failed breakout, which is a bearish situation. And that's my minimum target down here, 133.19. All right, we'll talk on gold real quick. I've maintained for a while now. I was earlier in the year, coming into the year, long gold for quite a bit, or via the mining stocks. That's my usual trading proxy. And then reversed it, did a short on it recently and closed that out just because my opinion hasn't been strong. I have not had any position now for a few weeks in the mining stocks. But I do note this 115.70 level has been a significant level in the past. So where price targets was all the way back here. We had a divergent high and gold was a short, and that was a price target, and we hit that level. Point being, you can see all the reactions. We got reactions from above here. Prices held there and then finally gapped down below that level, led to a waterfall sell-off, came back, hit it from below, and its resistance at that point, and we did pull back, tested it, finally broke above it, and now we're coming back to that level. So the indicators, oscillators aren't that clear to me right now, to be honest with you. My conviction's still not very strong on gold, but it is at support, and the overall, at least the intermediate term trend is certainly bullish. Near-term trend, short-term trend is bearish. And when we go to the 60-minute chart, I was updating this quite a bit, pointing out this purple bearish rising wedge, and I said the purple trend lines define the bottom of a potentially larger wedge. Either way, a break and close below this trend line would be bearish. Obviously, I posted that when we were up in there, and that's what happened. We gapped down below it and haven't looked back since. So that's the situation there. If you want to take a put your thoughts aside for a second, whether you're bullish or bearish on gold. Let's just look at a pure, simple but effective TA measurement to project how far a breakdown on a bearish rising wedge may go. You just simply take the widest part of the wedge, add it to where the prices broke down, and that's your measured target. Now that doesn't have to hold. It's just a rough estimate. And let's put a line there. If I put a line there, what's interesting, let me color this something that stands out here. We'll make that yellow. There's a reaction right there. A couple reactions there. So that's one potential target, and that's right at about 113. Again, I am not short. I have no desire to go short. But I just don't see enough here on the charts yet to go long at this point, other than the fact it was at support on the daily chart. We'll look at the miners real quick. I really didn't cover that in the previous video. Let's just see if anything stands out here. There was a support zone there, this former T1 zone that was hit. That was T1 target, first target on the upside. We failed at this resistance zone, and we sliced right through that on the pullback. That was an area where the miners could have held support. But again, I always say it's all about gold. If you're going to trade the miners, do not do so without keeping an eye on gold, because miners will ultimately follow gold. So I don't see a whole lot of support. There's a little bit right here about where we are, 2150, give or take, and that's defined by these reactions here. So I'll give you a support line there. So if gold reverses off that level on the daily chart I talked about, the miners are also at a support level. And then after that, they go all the way down to about the 2010 area or so before I see any significant support. But again, it's all about what gold does. And overall, again, I have no desire to short because we did put in this pretty powerful divergent low back here. And that may be the first wave up. This might be the first corrective wave of a new uptrend. And so we'll just watch it for now. Okay, here's a 60-minute chart on GDX. Looks a little better. There's quite a few reactions. This is a support zone that I had here, and that's where we're dancing right on the bottom of that support zone now. So again, that's the story on GDX. However, I look at this chart and I just don't see enough in here to convince me to go long. I'd rather be out of a trade and miss out on a reversal than get in one that either chops around or has more downside to go. It's all about being selective on your trades and wait patiently for the right setup. And so at this time, I'm just standing aside. All right, what else did we want to cover? A couple other sectors that stand out. I've mentioned recently the financials, XLF. If you look at the white line here and this white line that defines a bearish rising wedge, looks like that divergence is about confirmed. We're pinching right now. We don't yet have a bearish cross on the PPO, but very, very close. Any more downside, and we will, especially break of this bearish rising wedge pattern, and you also have horizontal support here to watch at 2471. We'll call it 2470 to be safe. But again, more importantly than that horizontal support is this uptrend line. So if and when that goes, that's a sell signal. And this was just a rough measurement of how far prices may fall, again based on the distance of the wedge right here, the widest part of the wedge. Gives you an idea that how deep a correction we could have in the financials if things play out that way. SMH, you guys know, I've been watching the semis, and boy, they just they refuse to break down, but they're pinching. I mean, they broke below this purple uptrend line, back tested, stay below it. We're pinching towards the apex of the wedge, and I'm referring to the two white lines here. So you have prices just moving up within there, and you're refusing to break down, yet really not going much higher. For weeks now, we're trading sideways to slightly upwards, although the last couple weeks it's been a slight downtrend. Very powerful divergences, and again, one of my favorite sectors on the short side in the coming months. And I'll just touch on the other two real quick. I talk about SOXX as another semi-ETF. There's a minor uptrend line / bearish rising wedge, breakdown back test so far, and we need to see that trend line go on SOXX. Then we have XSD, that's the Spiders Sp Semiconductor Etf, and this one's fighting for its life right now. You can see this white trend line pretty well defined. That's the key uptrend line to watch. I had this minor yellow uptrend line which broke, and you can see, I mean, this is TA 101, guys. See that doji? If I zoom in, it was saved by the bell. So we had a breakdown yesterday. Prices closed right back up on within that trend line, formed a doji, and we're dancing on it again today. So this one's just clinging to that level, you know, like a sailor overboard clinging to a lifeboat or something, and that's what we need to watch. So any more downside, especially a drop below yesterday's lows in XSD. But again, if I'm trading a sector, I'm going to watch all of the key ETFs. So I want to see SMH go along with it. I told you on SOXX I had an alternative trend line that's a little bit lower. So if we see these two go, SMH and XSD, let's just say safely, to be safe, below yesterday's lows, I think that's a pretty clear sell signal. And then I'll probably add those as official trade ideas. I've been holding off only because of the resiliency of these things, and I think the time is upon us very soon here. We just need just a little bit more downside for evidence. Here's the biotechs. Bigger picture was this yellow symmetrical triangle, which we broke out of, ran up. I had a resistance level here at 69. It respected that level, pulled back after just barely punching above it, and then had a thrust up above it. I added this other resistance level here at 73. Let me color that a little bit brighter so you guys can see it. Move this up. That was an old rising wedge back here. You can see the reactions. There was a reaction high, a couple reactions to the left of the chart, and so far that contained prices. Now, when we zoom down to the 60-minute chart, this one I shared recently, this is a rising wedge pattern. It broke down at this point. This was the projected move, the measured move. Again, the widest part of the wedge, right about there. Maybe I needed to extend that a little bit more, and that would project XBI down here. Now it did move up after that. We had an initial thrust down and a back test. We came in and back tested perfectly at the apex of that wedge, and we have since rolled over. At that point, we had negative divergence. Now we also had a divergent high when the wedge broke down, and again, those divergences played out for a minor correction, just not a whole lot, and we went on again. On the back test, most importantly, the divergences were not negated. They only became larger. We have larger divergences at this point. So near term, I don't have a strong opinion on the biotechs, but based on this chart, I have to favor some more downside. Okay, one other thing before I wrap this video up I wanted to cover is the VIX. The VIX is at and has been at its low end of its historical range, and we can see here this is positive divergence building on the VIX, bullish divergence, similar to the negative divergences it's been building on the broad markets. We had a divergent low here, and that certainly played out for a big pop in the VIX. We didn't peak till up here, 23. That's, that was a target there, or at least now that is resistance. That's a reaction high. I may have added that afterwards. I can't recall. And this is what's going on. I'm watching these purple trend lines, this descending price channel, but we have yet another divergent low down here. But what really stands out to me is when I zoom out to the weekly chart. Now I've overlaid the NASDAQ composite here so you can take a look at this. What I've done is highlighted the, let's expand this chart a little. Let's move these guys down. I've highlighted the bottom end of the VIX, the range in the VIX. Now over time those ranges change. If we go back, let me just jump back to a monthly chart, and this goes back to the mid 80s, so this is long term. You can see that these are the historic low end of the range right about here, and over time there have been different ranges or bottoms of the range, if you will. This point in time back in leading up to the tech bubble, volatility was a lot higher, so the low end of the range was a lot higher than it is today. But historically, this is really it, guys, right about here. This is the low end of the range going back, what is this, almost 30 years or something. Now let's go back to that weekly chart. I'll show you what stands out. So back in 2010, 2011, 2012, this was a low end of the range. So every time we got down to the low end of the range, we didn't stay there very long. And if you focus on this white line right here, again, this is a NASDAQ composite. So just follow the crosshairs, if you will. Follow the vertical line on the crosshairs, and you'll see that lines up with the bottom of the VIX and the top in the market. And this was a sizable correction. I don't want to drag the box. Let's see if I can do that. Okay, I can measure it. So it might not look like much, but that was a 25% drop right there. If I grab the correct line, which I believe I did, no, it's measuring the VIX. Even though I'm trying to measure the NASDAQ composite, it's going to grab the scaling here on the VIX. So I'm sorry, I don't have the scaling set for the NASDAQ composite, but that was a significant drop back there in 2010. Came back, visited the bottom of the range. We stayed under there for a while, and there's your next correction. So what happens? We had a reset. In recent years, from 2013 on, late 2012, this became the new bottom end. And as I just jumped out a minute ago to the monthly chart, that's the long-term low end of the range of the VIX. And now this was the first time we got there. So we hadn't really yet established that as the low end of the range. But once it was established, you can see here we had a reading here for a few weeks, couple months maybe, and then you can see that was followed by a correction there afterwards. We came back in, we touched the top of the range once, we had a little sideways correction. These weren't huge, but they were corrections, probably in the tune of this one maybe 7-8% or more, 3, 4, 5%. We visited it again, we dipped down within the range, especially when you get these readings down into the range here. But you can see we visited the top of the range, there was a correction, and that correction really never ended till here. We had a counter trend bounce, so from this point to there, that was the biggest drop the market had in years, and that was the late 2015 drop into early 2016. So there it is, and here we are. We've come full circle, and the VIX is now moving up off the very low end of its range, and yet we haven't even had so much as a 3% pullback so far. So again, by this metric and by a lot of other things, the trend is certainly up as of now, but we're just walking that line. We have a lot of indicators that are extreme levels, and all we need to see is the broad markets and a lot of those key sectors that I'm watching break those trend lines that I'm watching. And once we have those trend line breaks, I think it would be safe to say, it's a good time to, get short the broad markets or get more aggressively short individual stocks if that's your thing. Okay, this has been Randy Finney with The Right Side of the Chart. I hope you enjoyed it.